Hello, my name is Robert, and I'd like to welcome you to today's webinar, International Tax Lunch, Form 8621, How Foreign Mutual Funds Are Taxed and Reported webcast. Please note that this is a webinar, which means audio over PowerPoint only. Per the NASBA and CBA requirements, you will receive 4 attendance checks every hour. The attendance check will pop up over the webinar. Click the OK button to receive credit. Before we begin, there are a few things to note about the webinar platform. To your bottom left, there is a feature called Class Chat. Please feel free to use the Class Chat to talk with other online attendees about the content. The chat is not monitored. To your top right, there is a tab called Ask the Instructor. Please use this tab to ask any content-related questions, and we have reserved the last 10 minutes of this program for Q&A. To the left of the Ask the Instructor tab is called Group Form Only. Please fill out the form if you are viewing with another person so that everyone receives credit. Now let me introduce our speaker. Deborah Rudd is a CPA at Hodgen Law PC, an international tax law firm. She graduated from Columbia University with a Bachelor of Arts degree in philosophy and is now earning an MS degree in taxation. Every day for her means solving complicated cross-border tax issues, whether it's working through the intricacies of expatriation planning and tax compliance, massive cleanup jobs, or PFIC taxation. So before we actually begin with Deborah Rudd, Phil Hodgins will have a brief announcement to give you, and then we'll go into our main program with Deborah Rudd. So Phil, take it away.
Hey everyone, Phil Hodgen here, and welcome to our monthly Hodgen Law PC International Tax Lunch, and PC does not stand for politically correct. We do this every month on the second Friday of the month, noon Pacific time. You can listen in as you are right now, or we'll post this thing to YouTube later. And so off we'll go. This month's topic is Form 8621, How Foreign Mutual Funds Are Taxed and Reported. And foreign mutual funds are typically classified as PFICs, passive foreign investment companies, for U.S. tax purposes, and PFIC tax treatment is notoriously punitive, and that's where we start to get politically incorrect, because we use potty mouth words to talk about tax. Learn why foreign mutual funds are PFICs and all of that stuff, how to compute the income and the tax under the mark-to-market method of PFIC taxation, and we're going to talk through Form 8621 and preparation thereof. Our speaker today is Deborah Rudd. You can check her out on the website, hodgen.com, see who she is and what she does. And if you have a question during the presentation, type it into the box. We've got a separate laptop running with the questions going. If she has time during the flow, she'll answer them. Otherwise, we'll catch them all at the end as much as we can. If you have questions or comments or suggestions or anything like that, please let us know. You can shoot an email to deborah.rudd at hodgen.com, or me, Phil, P-H-I-L, at hodgen.com. Ask us anything you want. Anyway, that's it from me. Let's turn it over to Deborah, and she can start the game today.
Hey, everybody. Welcome to this month's tax lunch, and I promise I'll try and keep the potty words to a minimum.
No.
All right, so we're talking about foreign mutual funds today, and like Phil mentioned, these are usually going to be classified as PFICs, passive foreign investment companies. So what we're really talking about is passive foreign investment company tax. How you figure out how much tax to pay, how you report it on the forms, where you put it on the tax return, how it all works. So today we're going to cover a number of things. We're going to look at what exactly is a PFIC and why foreign mutual funds are considered PFICs for U.S. tax purposes. We'll look at 3 different ways that PFICs are taxed, really just as a summary, because what we're going to focus on is one of those ways, the mark-to-market method. We'll look at who can make that election, how a fund qualifies to be able to make that election, and when you would actually make that election. We'll then do some calculations for an example that covers 5 years, and we'll look at how you do the calculations over a 5-year period. And then we'll do some form preparation examples. We'll talk about how dividends are taxed. We'll talk about some special transition rules if you're not already operating under the mark-to-market method. And then very briefly at the end, we'll talk about how mark-to-market works in the offshore voluntary disclosure program, which is quickly becoming very irrelevant because that program is going to be ending soon, so we're not going to spend that much time on that. So let's start with what is a PFIC. The definition of a passive foreign investment company is a foreign corporation that meets either one of two tests. The first one is the income test, and this is where at least 75% of its gross income is passive, or it can meet the asset test, where at least 50% of its assets are passive or are held for the production of passive income. Now, what do all these terms mean? When we talk about a foreign corporation, you're probably, if you're not familiar with these rules already, you're probably already wondering, great, so why is a mutual fund a foreign corporation? We'll talk about that in a minute, but it starts with the idea that something that is a foreign corporation for U.S. tax law might not actually be a corporation in the jurisdiction where it was organized or where it operates. So we have to look at the U.S. tax law meaning of corporation. And for a foreign corporation, it would be organized outside the U.S., and then corporation means this special designation under U.S. tax law. This includes all the entities that are listed under this regulation section 301.7701-2B. All of those are considered per se corporations, and those will always be corporations under U.S. tax law. Any other entities have the option of either electing their classification, or if they don't do that, then they fall into the default rules. If an entity has two or more members, and one or more of those has personal liability, then it defaults to a partnership. And if there are no members with personal liability, then it defaults to a corporation if there's two or more members, or just a disregarded entity if there's one member. And when we say the word passive, because we're talking about foreign corporations that have passive income or passive assets, we're talking about, for passive income, we look at the definition of foreign personal holding company income under Section 954C. This includes stuff like interest, dividends, royalties, rents, annuities, gains, etc. There's a number of other things that are part of that section if you take a look at that. When we're talking about passive assets, we mean things like cash and any other assets that produce or are held for the production of passive income. The way you calculate passive assets is by taking the average of the assets at the end of each quarter, each of the 4 quarters in the year. And one thing to look out for is watching for assets that are off balance sheet. Those are something that you would want to consider in looking at the passive assets. These would be things like sometimes intangibles, goodwill, things like that. So this brings us to why foreign mutual funds are usually PFICs. They are organized outside the U.S., so they're foreign. They're typically organized for investment purposes, which will mean that they're considered business entities under the U.S. tax laws. Typically, the investors in foreign mutual funds do not have personal liability, which will make them be a corporation under the rules that we just talked about. Generally, they're going to be making investments that receive 100% passive income. Those investments will hold passive assets. And usually, a mutual fund will meet both of the PFIC tests, even though only one is needed. So what you end up with is a foreign entity that's considered a corporation, and at least one of the tests are met, so your foreign mutual fund will usually be a PFIC. There are some easy ways to know if you have a PFIC. If you're, for instance, in the situations we're going to be talking about today, you would want to look at, for example, if you have a foreign brokerage account, stock trading, securities, look at that account and see if you have mutual funds or something else that says fund at the end of it. Very commonly, these are going to be PFICs. The other thing you look at is its International Securities Identification Number, or ISIN. If that number starts with a country code other than US, that means it was probably organized outside the US, meaning that it's probably foreign. So if you have this foreign fund, very likely it's going to be a PFIC. Some of the common examples of PFICs, and this is a very limited list, there's many other ways that you can have PFICs, but the things we'll be talking about today: mutual funds, exchange-traded funds or ETFs, bond funds, currency tracking funds, precious metals funds, hedge funds. These are the types of things that you might see in this type of account. There's also other ways that you can have PFICs. For example, if you have a startup and it's very cash heavy, that might qualify as a PFIC. But we're really just looking at foreign mutual funds and similar funds today. Now let's take a look at the ways that PFICs are taxed. As Phil mentioned, PFICs have a notoriously punitive tax treatment. So that's why this has the subheading bad, worse, and worst. We're actually going in the opposite direction in terms of order, though. We're starting with worst and working our way down to bad. So the default method, this is what happens when you don't make any elections. This is typically going to be the worst tax treatment that you can have for a PFIC. Next least bad is mark-to-market. That's going to be the one that we're talking about a lot today. This is going to be the most preferable treatment if QEF is not available, and this requires making a pretend sale at the end of each year and paying tax at ordinary rates, typically not going to be able to take advantage of any capital gain rates. Qualified electing fund, this is usually the most preferable tax treatment, and this will allow flow-through of income to the shareholder, and you get to pay capital gains rates on capital gains. I've made a little table here that describes the different things that we just talked about: default, mark-to-market, and QEF, and it just kind of lays out so that you can visually compare the different methods and the things about them that work a little bit differently. So under the default method, you're going to have a mix of maximum, individual, and ordinary tax rates. There is an extra charge of daily compounded interest that adds up over most of the life of the PFIC when you sell it or when you have a dividend. And losses are going to be capital. The result is this is pretty bad because you're paying really high tax rates. On top of that, interest is computed, and losses are going to be capital, so you don't even get to take the losses in the same way that the tax is computed. Mark-to-market, this is taxed at ordinary rates. There aren't any extra interest charges the way there are under the default method, but there are limitations on the way that you can take the losses. This is a little less bad. QEF, there is income pass-through, so you get ordinary and capital rates. There are, again, no extra charges, and there are limitations on losses, and the result is this one is going to be the least bad. The way these are calculated, we don't really need to spend much time on the default or the QEF, so we're going to kind of just summarize that. For the default method, this is where you would have a Section 1291 fund. That's what it's called when you have a mutual fund under that method. You would allocate your gains over the entire holding period, apply maximum tax rates to each allocated period, compute interest on top of that, and your current year amounts that you allocated to the current year are taxed at ordinary rates, and there's limitations on losses. Again, we're not going to spend any time on that, really. That's just sort of a summary. Mark-to-market, you're going to be paying tax at ordinary rates on unrealized and realized gains, and there are limitations on recognition of losses. And the QEF is going to work sort of similarly to partnership income. Just notice we did have a question come in. For the most part, I'm going to reserve these for the end, but might as well take care of this one right now. Someone asked, the default method only applies in the year in which there is an excess distribution as defined under the code. That's correct. A year in which there is a distribution, you have to calculate if any part of that is an excess distribution as defined under the code and compute tax on that. Also, if there is any dispositions. A lot of times what you'll see is redemptions of stock in order to pay account fees or dividends that get reinvested. All of those are going to be taxable events under the default method. So let's talk about the basics of the mark-to-market election. Who can do this, what PFICs qualify for the election, and when the election must be made. So in terms of who is eligible, if you're just a normal, regular individual who owns a PFIC in a foreign account, you personally are eligible to make that mark-to-market election, assuming that the PFIC is also eligible for that election. If you own the shares through a pass-through, you can make the election then. And if you have a controlled foreign corporation that owns PFICs, the controlling U.S. shareholders would make the mark-to-market election on behalf of the CFC. If this is done, that election only applies to people who are U.S. shareholders, in quotes, as defined under Section 951B, and those are people who own 10% or more of the vote or value of that CFC. Now, here's the part that I don't see many people think about much, and this is the fact that for a PFIC to be able to use, or for a shareholder to be able to use the mark-to-market election for a PFIC, that PFIC has to be what's called marketable stock. And this is found under Section 1296E. Marketable stock is defined in the regulations. It means stock that's regularly traded on a national exchange registered with the SEC or any other exchange or market that meets IRS qualifications. Regularly traded is also defined in the regulations, and it means if it's traded on 15 calendar days in each quarter. The IRS has also, of course, provided qualifications for what types of stock exchanges this can be traded on to be able to make the mark-to-market election. They need to be exchanges that are regulated or supervised by governmental authority, that have specific measures in place to prevent fraudulent activity, and those measures are actually enforced. The market is free, open, and fair, and the rules of exchange promote active trading of stocks. And I listed the regulation section where you can find this information. Now, for the most part, like I said, I don't see many people actually think about these rules very much. For the most part, most of the major exchanges that you're going to see where things are most commonly traded will probably just meet these qualifications. I remember a number of years ago doing a bunch of OVDP cases, actually, and I don't remember a single auditor in any of those ever asking, wait, is this marketable stock? And we were dealing with UBS accounts and Credit Suisse accounts and things like that, where people had mutual funds, ETFs, and it was never really called into question whether any of those were PFICs. The auditors just naturally assumed that they were. So those types of accounts, if you see things that look like PFICs, very probably they are. And very probably they'll qualify under the marketable stock requirement. Now, this is one of the more difficult questions, when to make the election. And I don't mean that you have a whole lot of options. What I mean is, by difficult, a lot of times you don't realize that you need to make the election until it's late. One of the things for the mark-to-market election is it does need to be made with a timely filed return. Late elections are allowed only in certain situations by using a private letter ruling, and there are certain qualifications for that. that I've listed here on the page. The main thing to consider here is you have to pay private letter ruling fees and professional fees to get a private letter ruling. Most people I see have PFICs with less total value than it would even cost to apply for a PLR. So I've never actually seen someone go this route in making a late mark-to-market election. And it's usually not necessary to do that because there is a way to start making the mark-to-market election if you find out a little bit too late that you need to. So on this slide, number 19 here, I've listed 3 different scenarios where you can make timely elections. So let's say in the first one that a person acquired the PFIC in 2017. Right now it's 2018. Let's assume this person filed an extension a couple days ago and they still have time to timely file their 2017 return. They would be able to make a mark-to-market election for that first year of ownership, and the rules would work normally. So this is what we normally think of when we're talking about a timely election. Another way to do it is under this rule in section 1296J, this is a coordination with the default rules, and this is for people who realize a little bit too late that they need to make the mark-to-market election or that they want to make the mark-to-market election. So this one would apply to, let's say you have someone who acquired the PFIC in 2015, and right now it's time to file their 2017 return. They never reported the PFIC, they didn't know what they needed to do, and now they just learned about it. So what they can do is use this coordination rule and make the mark-to-market election for the first time in 2017. I actually have a couple slides about how this works a little bit later in the presentation, but basically you operate under the default rules for the first year of your mark-to-market election, and then in the second year of your mark-to-market election, the actual mark-to-market treatment kicks in. So it's a little bit of a time delay, but it does eventually get you to where you want to be. The last way you can make a timely election is if you follow the transition rule for inbound immigrants under 1296L. And this one is if someone owns something that is a PFIC, but that person isn't yet a U.S. person subject to U.S. tax, they become a U.S. person through whatever route they choose to take. And at that point, they want to use the mark-to-market election for their PFIC. If they do it in the first year that they're a U.S. person, they can make the mark-to-market election, and they get a step up in basis to fair market value for when they become a U.S. person. And we'll talk about that one a little bit later as well. Now that we've talked about some of the basics, who can do this, what types of funds it applies to, when to do it, let's do some actual calculations and see how this works year to year when you're marking the PFIC to market. So just a quick overview. What you're going to do is every year at the end of the year, you'll do a pretend sale and recognize the gain or possibly the loss at the end of the year. If you have a loss to recognize, there are limitations on how much loss you can take, and these are tracked by something called unreversed inclusions. You can recognize losses only up to the amount of previously recognized gains, and that amount is reduced by any losses previously recognized. So you basically keep a tally of all the gains you've recognized and all the losses you've recognized, and the total gains you've recognized is the amount by which you limit the losses you can recognize. And we'll take a look at this in much more detail so that it actually makes sense in a second. Each time you recognize a gain, the basis adjusts up for that amount, and obviously each time you recognize a loss, your basis will adjust down for the loss recognized. The way this is taxed, gains will always be ordinary income, taxed at ordinary rates, and this includes both gains from mark-to-market pretend sales at the end of the year, and also gains from actual sales when you dispose of the PFIC. Losses are going to be usually ordinary, but only up to the amount of unreversed inclusions. So if you have a mark-to-market loss at the end of the year from the pretend sale, you would recognize losses only up to the amount of unreversed inclusions, and then you would stop there. You don't recognize any losses in excess of unreversed inclusions. If you have a sale, though, where you actually dispose of the PFIC, at that point, you will recognize your losses as ordinary up to the amount of unreversed inclusions, but when you have the actual sale scenario, any excess losses beyond your unreversed inclusions are going to be capital. Let's do some actual math, so all the things I said start to make sense. So we're going to use this example. Let's say you have a client who purchases 100 shares of a mutual fund, we'll call it Fund A, on July 1st, 2013 for $10,000. Fund A is held for 4 years, and then all 100 shares are sold on June 30th, 2017. And just to keep things nice and simple, we'll say no dividends are ever paid on Fund A. Though even if there were dividends, it would be pretty simple, and we'll talk about how those are taxed a little bit later. So when you're doing a mark-to-market calculation for a client, there are certain pieces of information that you'll need. For a mutual fund held in an investment account, you'll just need to get bank statements showing all the purchases and the sales of the fund. It's really helpful to have the year-end asset valuation statements. Typically, these are issued every December 31st. These will show you the market values of the fund. If you can't get that, it's also acceptable to use historical per-share values from an online source, hopefully a trustworthy online source. I would recommend that. And then you'll need exchange rates because almost certainly you're going to be working in currencies other than US dollars. So let's say you got the bank statements and you have this transaction data. It's just summarized in a table here to make this convenient, but obviously if you were working with the bank statements, they probably wouldn't put it together so nicely for you. So July 31st, we have a purchase. Value is $10,000. And I'm just going to be working in US dollars here, assuming that this started out in a foreign currency and was converted to nice round numbers for example purposes. At the end of the year in December, it's worth $12,000. End of 2014, it's worth $11,000. 2015, worth $8,000. 2016, $10,000. And then on June 30th, 2017, you have a sale for $15,000. So you can see the value fluctuates up and down over the years, and then they end up selling it at a gain. Now this slide is sort of your starting point for how you're going to report everything on the 8621s. This one shows whether you have gains or losses, how the basis gets adjusted, and what your unreversed inclusion is going to end up being. And we'll cover this over a series of slides where we look at each year. So you might want to take this slide, either print it out, pull it out of your printout package, or somehow set it off to the side so that you can continue to refer back to it. So July 1st, 2013, market value $10,000, that's your purchase price. And when you purchase it for $10,000, you get a basis of $10,000. At the end of the year, its market value has gone up to $12,000, so you have a $2,000 gain. You recognize that $2,000 gain, giving you an adjusted basis of $12,000. Because you recognized a gain of $2,000, that means your unreversed inclusion also goes up by $2,000. So you now have $2,000 of unreversed inclusions that you can potentially use as losses in the future. 2014, it goes down to $11,000. That means you have a $1,000 loss from your previous adjusted basis of $12,000. You have $2,000 of unreversed inclusion, so you can take a loss of $1,000. That gives you your resulting adjusted basis. Your previous year it was 12. You recognize the loss of 1,000, and your resulting adjusted basis goes down to 11. Now at this point, I'm actually going to stop going through the table here and go on to the slides, because each of these slides is going to explain each row of this table probably in a little bit better way. So like I mentioned before, pull out this slide if you think it'll be helpful, and we'll go through each of these. Now, just carrying on from the previous slide, where you have a gain, I've just assumed in this situation a marginal tax rate of 30%, meaning you can look at your relative tax cost or savings for this just to get a sense of when you have a PFIC gain or when you have a PFIC loss, what kind of impact it actually has on your tax return. Now let's take a look at the specifics of the example. So this is meant primarily as a detailed way of tracking the unreversed inclusions through the years from the beginning of when you purchased the PFIC through the end, when it's sold. So we start with 2013. If you refer back to that slide 27, you'll see it was purchased for $10,000. At the end of the year, it's worth $12,000, and your fair market value increased by $2,000, so you recognize the ordinary gain. Your adjusted basis increases by $2,000, and then you take that $2,000 and put it in this imaginary bucket for unreversed inclusions. And this is a good way to think of it, buckets, baskets, however you want to call it, because you can't have less than nothing in a bucket, just like you can't take more losses than you have unreversed inclusions. So once your unreversed inclusions go down to 0, you can't take any losses beyond that. 2014, your year-end market value, as we mentioned before, goes down to $11,000. This is a $1,000 decrease from the prior year. You have $2,000 in the unreversed inclusions bucket, so the full loss is going to be allowed. That means your adjusted basis decreases by $1,000 down to the actual fair market value of $11,000. You use the loss, so you take $1,000 out of the unreversed inclusions bucket, and you have $1,000 of unreversed inclusions left. $2015, this is the one where there's a substantial decrease in the market value. It goes down to $8,000. This is a $3,000 decrease from your $11,000 adjusted basis. And if you recall, you only have, at this point, $1,000 left in the unreversed inclusions bucket, so you only get to take $1,000 of loss. That means you recognize a $1,000 ordinary loss. Your adjusted basis goes down to only $10,000, even though the market value is $8,000. And because you recognize the $1,000 loss, you take $1,000 out of your unreversed inclusions bucket, and you now have nothing left there. Now let's say, this isn't actually what I put in the example, but let's say, for example, that you decide to sell the PFIC on January 1st, 2016, and on that day it's still worth $8,000, just like it was the previous day. And at that point, your adjusted basis is $10,000, so you're going to have a $2,000 loss. You have no unreversed inclusions left because you used them all. So what happens is, because you have an actual sale with a loss that exceeds unreversed inclusions, the $2,000 loss is going to be a capital loss. And this is important to remember. The loss in excess of unreversed inclusions is going to be capital only if there's a disposition or sale. If it's just a mark-to-market loss where you're doing the pretend sale, you don't get to take the capital loss, and you can only take a loss up to the amount of unreversed inclusions. So, in our example, we actually didn't have a sale in 2016. We had a 2016 market value at the year end of $10,000. It's a $2,000 increase from the previous year when it was $8,000. But if you remember from 2 slides ago, the adjusted basis is $10,000, so you don't recognize a gain even though it increased in market value. This leaves your unreversed inclusions the same because you're not recognizing a gain, so it doesn't increase, and your adjusted basis stays at $10,000. Lastly, finally, we're nearly done with this. In 2017, you sell the PFIC for $15,000, and again, your adjusted basis is $10,000. You have a gain of $5,000, and your unreversed inclusion, of course, increases to $5,000, but you can't use it because you don't have any of the stock left. And that's another thing to remember. Let's say you have multiple mutual funds that you're doing these calculations for. If you have an unreversed inclusion for one mutual fund, that unreversed inclusion stays with that mutual fund. You can't transfer that to another fund and use the losses on another fund. So they basically live and die along with the fund. All right, now let's take a look at how you actually fill out the forms. And we're going to be using the same example here. You're going to be filling out a separate form for each PFIC for each year. You, at the top of the form, list your name and information and the PFIC's name and information. Part 1, this is an informational section only. You fill out lines 1 through 4 and 5C. Part 2, you'll check the mark-to-market election box. And Part 4 is where you actually put the mark-to-market information. So you'll fill that out based on the numbers that we've talked about. So let's look at the forms. So this is just a sample page 1, top of the page, with the made-up taxpayer address. This is an individual, so we check the box for that, put in the fund name and information, and we note that this one is for the 2017 tax year. Part 1, this is where you give information to satisfy the information only part of the requirements. Line 1, you just give a description of the shares. Line 2, date shares acquired during the year if applicable. In this one, I'm assuming this one is for 2017, so there were no acquisitions in 17, so we leave that one blank. Number of shares held at the end of the taxable year. Again, this one is 0 or blank because this is the year of sale, so there was nothing left at the end of the year. And value of shares held at the end of the taxable year, well, that's 0, so we check the 0 to 50,000 box. Line 5, type of PFIC and amount. We can skip over the 1291 and 1293. So the amount of inclusion or deduction under Section 1296. Check the box for C, 1296. And this is the year of sale where we had $5,000 included in income. So this is part 2. You just see box C checked for mark-to-market election, and you would check this every year that you're filling out the 8621. And then part 4. So I've filled out one of these for each of the years. We can go through these relatively quickly. Line 10A, fair market value of stock at the end of the year, 12,000, adjusted basis, 10,000, and that's a 2,000 gain on 10C. And this is the 2013 numbers. Moving on to 2014. Next slide. We have fair market value 11,000, basis 12, so there's a 1,000 loss. And here on line 11, this is where you put the amount of unreversed inclusions. we had 2,000 unreversed inclusions, and so on line 12, this is where you show the loss that's going to be taken as an ordinary loss on the tax return. This is a $1,000 loss. 2015, again, pretty much the same thing as the prior year. 8,000 market value, 11,000 basis, 3,000 loss, $1,000 of unreversed inclusions, so you get a $1,000 loss. 2016, this is where everything stayed the same. You have market value 10,000, basis 10,000, no gain, no loss. And then the last year, line 13, where you sold the stock, that bold line there, this is where you fill out market value on date of sale, 15,000, basis 10,000, gain 5,000. So where do all these numbers actually go? That's the important question. The mark-to-market gain or loss goes from line 10C or 12 on Form 8621 over to the line 21 of your tax return, Form 1040, and that is going to be where that is reported and taxed. Also, on your line 21, if you have a gain or a loss from the sale from line 13C or 14B, that'll go to line 21. And then for the loss on a sale that exceeds your unreversed inclusions, take the loss up to the amount of unreversed inclusions on line 21, and then the remaining loss is going to be capital. So that'll flow to your Schedule D. So on the 2017 Form 1040, you can see there on line 21, $5,000 of income, and this is the gain from the sale. Now, talking about dividends from mark-to-market PFICs, this is the other thing you're going to see very frequently in these types of funds, in these types of accounts. There's actually no special tax treatment for mark-to-market dividends. They are not subject to the excess distribution rules of Section 1291. There is nothing in Section 1296 that specifically covers the taxation of dividends. Nothing in any of those regulations relating to distributions. And so it seems that mark-to-market dividends are actually taxed according to the normal rules for dividends. There is one exception, though. Qualified dividend rates are not allowed for PFICs, and this is because qualified dividend rates are allowed for what is called qualified foreign corporations, and PFICs are specifically excluded from the classification of being a qualified foreign corporation, actually under Code Section 1, Paragraph 11, or Paragraph H, 11C. PFIC dividends for non-Section 1291 PFICs and non-QEFs then are taxed at ordinary dividend rates. So that looks like everything you'd normally expect to see for a dividend on a tax return goes on Schedule V, flows to the Form 1040, and just has to take the ordinary rate. Now let's talk very briefly about transition rules. Okay, so there's a couple different ones that I want to cover. First is the coordination with Section 1291, and this is the one that's covered in Section 1296J. I mentioned this one previously. So this is the one that you use if you've been operating under the default method and you realize a lot of times what happens is you don't even realize that you have a PFIC, you don't know what a PFIC is, you don't realize that the things you have are subject to this special tax, and at some point, maybe a tax preparer or someone says to their client, hey, looks like you have some PFICs here, let's talk about options for those. And it's at that point that a lot of people say, oh yeah, mark-to-market election makes sense. So that would be a person who is filing a U.S. tax return every year, is operating under the default method, might not even know it because they've never made any elections, and they decide they want to switch over to the mark-to-market election. So the way this works is, let's say that you've had a PFIC since 2015, and you're now preparing your 2017 return. So let's say that you're going to make that election for mark-to-market for 2017. So what happens is, for the tax year 2017, you're actually kind of living in two worlds at once, where on your Form 8621, you're checking the box saying, I'm making a mark-to-market election. But in reality, for that entire first year, you're actually still operating under Section 1291. Any distributions that are made, you have to check for excess distributions and compute the tax accordingly. Any dispositions, if you have a gain, that gain is an excess distribution. And if you have a loss, that would be actually capital loss. And then on the very last day of 2017, you do a pretend sale, and you tax that according to the excess distribution rules. So if there's a gain, that's an excess distribution. And then from that point forward, December 31st, 2017, that creates your adjusted basis for your first year of actual mark-to-market calculations. It'll be 2018 that you do the pretend sale at the end of 18 with your adjusted basis from the end of 2017, and that'll be taxed according to the mark-to-market rules. So it's really in the second year of the mark-to-market election that you start operating under this 1296 rules the way you would expect if you're using this special transition rule. Now, there's another rule for inbound immigrants that I had mentioned previously. This is where you make the mark-to-market election in the first year of U.S. person status. So the assumption here is that you had a PFIC, maybe you've had it for years, you then become a U.S. person, you're subject to U.S. tax for the first time, and when that happens, you get to take a step up in basis on the first day of your taxable year for purposes of calculating your mark-to-market gain. So as of that day, you can use the greater of fair market value or adjusted basis. For other purposes, no step up in basis, and when you sell the PFIC, your basis step up amount is going to be taxed as a capital gain. Now, lastly, as I mentioned before, this part of the presentation is very quickly becoming obsolete. Just a few more months for people to go into the OVDP, but there are a special set of rules for how mark-to-market works in the OVDP, so I wanted to cover those briefly. So, you can find the rules for this under FAQ number 10 for the frequently asked questions for the OVDP, and if you just Google IRS OVDP FAQ, you will find that page. The streamline procedure, very common option for people who are fixing their tax compliance, actually contains no provisions for mark-to-market election, and you still have to follow all the normal rules for timely elections. So if you're entering the streamline procedure and you need to report PFICs as part of those submissions, I don't think you can use the mark-to-market for those. You can use it starting in the current year under the transition rule we talked about, but you can't use it for the past years. It's only in the OVDP that it allows you to do a non-timely mark-to-market election. So if you're using mark-to-market in the OVDP, if you make this election, you have to use it for all of your PFICs. You can't do it fund by fund. The fair market value on the last day of the year prior to the OVDP period is going to be the adjusted basis, unless it was acquired during one of the OVDP years, obviously. You do the gain and loss calculations under the mark-to-market method for all the OVDP years. And then instead of including the gains and losses on your line 21, you're actually going to use a set tax rate of 20%, and you add that 20% into other taxes so that it appears directly on page 2 of your Form 1040. And in the first year, there's also an extra 7% that's added onto that, and then all of the other years are 20%. Then, assuming you still own PFICs after the OVDP period ends, what happens in that first year following the OVDP is all the unreversed inclusions that you've accumulated over the OVDP period, everything is reduced to 0, and you can still continue using mark-to-market method, but you'll be starting accumulating your unreversed inclusions from scratch at that point. So that's it for today's presentation, and we have a number of questions that I'm going to talk about in just a second. Just though a quick mention that this presentation is not legal or tax advice. You can't use it to avoid penalties. Hire someone to help you. And if you'd like to talk to me after the presentation, all my contact info is there on the last page. Okay, questions time. So, number of questions here. I'm going to read them out so everybody listening can hear them, though if you're, should be able to see these as well. Here's the first one. For the first year of transition for inbound immigrants, for example, a taxpayer just got their green card, can they elect QEF instead of mark-to-market? The answer is absolutely if they meet all the qualifications for making the QEF election. That means the fund has to issue what's called a PFIC annual information statement, and that has to give you all the information that you need to report under the QEF method and calculate your tax correctly. So what I've found is most of the time mutual funds and other similar funds that are traded on exchanges, typically they're not going to be issuing QEF statements to their investors. So that's why for this type of account, the mark-to-market method will be the most common, because you can't get that statement for the QEF. In privately or more closely held investments, that's where the QEF is much more common. Also, people who hold U.S. partnerships and those partnerships make investments on their behalf, that's another place where you'll see the QEF a lot of times. Okay, another question. How do you make the Section 1291 election? This one is, you actually do not make the Section 1291 election. There is no election. Section 1291 is what happens to you if you don't make any elections or if you are not able to make any elections. This is the default treatment for PFICs. So this is the type of situation where the worst, most punitive tax treatment is what happens to you if you do nothing. So Section 1291 would not recommend operating under that method if you have any choice about it. So here's another question. Can you include the mark-to-market income on Form 1116 passive category? So this is asking if you are able to take a foreign tax credit for the mark-to-market income. I believe that you can do this, yes. There are, if you're stuck operating under the default rules, there's some really, really specific rules that you follow for how you can take the foreign tax credits. but for mark-to-market, I believe that you are able to. The problem is you didn't pay taxes in the foreign country on this income because there was no actual tax event. You're doing a pretend sale. This is all made up, so you're recognizing income from something that didn't actually happen. So you can include it in the income category on your 1116, and if you're in a high tax country, maybe that'll help in terms of making more of the tax credit allowable, but typically you won't have an actual tax credit to take for the mark-to-market fund because you're doing a pretend sale. Here's another question. Are you doing this for each fund within your foreign brokerage account or for each brokerage account? This one's really important. This is actually for each fund. You're doing a separate mark-to-market calculation for every single fund. I have worked with clients who had brokerage accounts with 60, 70 mutual funds. And so I did these calculations for over a 5-year period, over an 8-year period for each of those 60 to 70 funds for a number of people. And you unfortunately can't take the shortcut on that and just report the brokerage account as a PFIC itself. Okay, more questions. Here's a good one. If you purchase and sell the mutual fund in the same taxable year, is it still subject to the PFIC rules and reporting? The answer to this is, I think technically yes, but the results are the same as if it was not. Because what happens is, let's say that you have a short-term capital gain where you bought and sold a stock in the same year, that would basically be taxed, that would be taxed at your ordinary tax rates. Same thing's going to happen for a PFIC. Let's say you make no elections and it just operates under the default rules, you're going to end up with the entire gain allocated under the excess distribution rules to the current year, meaning it'll just be taxed as other income on line 21, subject to the ordinary rates. So technically, you're operating under the PFIC rules, but it has the same results as if you were not. Okay, looking for more questions here. Here's an interesting one. Can I use the mark-to-market for foreign mutual funds inside a foreign pension? The answer to this is I don't see why not, as long as you follow any applicable transition rules, follow all the unreversed inclusions rules, report everything correctly. This is, of course, assuming that your foreign pension requires you to tax the income inside of it and you're looking at all the PFIC look-through rules. Yeah, absolutely. Don't see why you couldn't do that. Let's see. Just checking to see if there's any. There's a couple more questions here. Don't think we're going to have time for all of them. How are we doing on time, Robert?
You got 1 more minute.
1 minute? Okay. I'll do one more and then pass it over to Phil. Okay, let's see. Here's one specific to mark-to-market. How do you handle distributions, additional purchases, and reinvested dividends with mark-to-market, sales of a portion of the holding? So distributions, you're going to look at the dividend rules the way we discussed kind of towards the end of the presentation there. Additional purchases, those will be added into your basis. Reinvested dividends, tax them in the way it's basically pretend that you have a dividend and then a purchase. So you track those in the same way. And then sales of a portion of the holding, you basically can track the stock in blocks of shares and report the sales in that way. Someone else actually asked that a separate question that I didn't get to about software or shareable spreadsheets. I've certainly made a number of spreadsheets over the years, but there is software for this. So really, you don't actually have to go through this. There's software that you can buy, and you can upload the transactions, and it basically does all the work for you. So feel free to reach out to me, ask me about that. That brings us to the end. So Phil's going to say a couple words, and then we're done. Thanks, everybody.
All right, thanks, Deborah. Really appreciate it. And not to be, this is unsolicited sales pitch, but the software that we use and like, go look at form8621.com. That's Mary Beth Logan's stuff, and it is superb. We threw away all of our custom spreadsheets after finding that, quite frankly. Anyway, thanks for all of you for participating. Next month, our session is going to be given by Hao Shen. He's going to be talking about withholding on distributions to foreign partners who are in a LLC or a partnership. So if you've got a 1065 and you've got foreign partners and you need to be doing withholding, that's what he's going to be talking about. If you are not on our email list right now, please go to hodgen.com/newsletters, sign up, and you'll get notification about next month's stuff, and you get materials and all that fun stuff. Anyway, that is all for us. Thank you, and see you again next month. And Robert, it's over to you.
Thank you, Phil. And I'd like to thank Deborah Rudd and everyone attending online. Certificates of completion will be available for download within 3 business days. Thank you all for joining, and have a great day.